capital investments finance to order. So who's going to take the role today? Who's in charge?
Mr. Chairman, Karen Vaughn, I'll do that.
Thank you, Karen.
Absolutely. For the Select Committee on Capital and Financing and Investments, Thursday, February 10th. If I get my days right. Representative Schwartz.
Here.
Representative Obermuller.
Visible.
That counts. Representative Larson.
Here.
Representative Harshman.
Here.
Representative Hallinan.
Here.
Senator Nethercott.
Here.
Senator Kinski.
Excused.
Senator Hicks.
Here.
Senator Guru.
Here.
Senator Driscoll.
Excused.
Thank you. Vice Chairman Nicholas.
Here.
Chairman Perkins.
Here.
You have a quorum.
All right. So, Mr. Vice Chair, you have any comments this morning, or we just jump into it?
Well, I like the looks of this crew. We should meet more often.
Yeah, especially this time of day. So if we can start a little earlier, maybe even that would be better for all of us. But anyway,
I think
so
he's going to
thank you
get his
for-
wish next week.
yeah, we get to see each other a lot here, beginning quick. So I think on our agenda which bill do we have first on our agenda? I can't keep everything up on my screen at once on this small screen.
22 LSO 307
All
version 9.
right, so let's go ahead and take that one up. And is Ian or Brian going to take us through this really quick?
Mr. Chairman, this is Ian Shaw. I'm available to talk about this one.
Okay, go ahead, Ian.
Great. We haven't had a lot of discussion about how much detail you want from LSO on this bill, but it is relatively short. I think there's two main purposes of this bill that I'll discuss consistent with our last meeting where we discussed the Idaho model and their move to an endowment model in both their constitution and in their statutory law. This constitutional provision is not intended to do everything that the related statutory amendments would do. Instead, it's intended to provide the broad framework that would then allow the legislature to come in and make some changes to the statutes specific to the Permanent Mineral Trust Fund and the common school accounts to further refine our move to an endowment model. But the purpose of these constitutional provisions is to make sure that we have the ability to do that. And then because of the timing of the general election, these constitutional amendments, if we don't get them done now, would have to wait longer before they would be done. And so that's, I think, part of the purpose behind tackling this part of it now. There's two main things that this constitutional amendment does, and consistent with this committee's wishes. It changes the language so that the state of Wyoming can meet its spending obligations from all of its investment gains instead of just from income. That's been a significant limitation that the state has been faced with, particularly to the Permanent Mineral Trust Fund and the school accounts. Second thing it does, which of course is related, is it moves to an endowment model. The endowment model is part of that is the concept that our investment gains, particularly our unrealized gains, should be freed up to be used as part of our investment policies and as part of our standing policies without being limited to only that income that comes from, for example, the Permanent Mineral Trust Fund. So the purpose of this bill is to do both of those things. And if you'll turn to page 3 of the draft, and that's 307.9, really the meat of this is all in the very beginning of that page. It says that investment gains, which may include both realized and unrealized earnings as prescribed by the legislature, shall be credited to a separate earnings fund on not less than an annual basis. That's the crux. So sorry, was there a comment? Okay, sorry. That's the crux of this bill, is in that simple language. We have changed the words income from fund investments to investment gains. And then we've allowed all those gains, both realized and unrealized, then to be credited to a separate account. So that does two things. Again, it makes us not reliant on only the separate category of income to meet our spending obligation. And instead, we can rely on all gains to meet those obligations. And then it allows all of those to be credited to a separate account. We have freedom under this language to pick which account we want to use. And in fact, some of the preliminary drafts of statutory changes that would accompany this amendment, we could even use the existing reserve funds to serve as a separate account. But either way, we have the option to designate account into which all gains can go, and then consistent with an endowment model, the funds are then fungible. Between the different kind of investment categories and different investments we have. So I think it serves that purpose. A couple of other things that this bill does that are important. It retains the fact that the funds in the permanent mineral trust funds are inviolate. It retains that they can be invested as prescribed by the legislature. One new thing this bill does, and it's a matter of providing clarity, it provides that the legislature shall prescribe by law the manner, means, and timing for supplying losses to the permanent mineral trust fund. I think that the committee over the years has discussed this topic a lot and tried to define or understand what the state's obligation is to supply losses to a permanent fund. I think that it's widely known that we have an obligation because the fund is inviolate and because we have some obligations to future beneficiaries. The question is, what is the extent of that obligation? And we have always repaid losses in one form of another, but the Constitution has been ambiguous and to what part the legislature can play in defining when and how we do that. The simple purpose of this is to make it clear in the Constitution that the legislature does get to designate how that's done. For example, an unrealized gain doesn't have to be paid right away, or that we can at the end of a year make supply losses. With this new language, the Constitution would clearly provide the legislature with that authority and resolve that ambiguity. An important part of this provision, and something I'm sure will be discussed today, is the spending limit. On page 3, starting at line 9, we adopt a spending policy, and the number that is in there now is 8%. It provides that all the gains, all investment gains, realized and unrealized, are transferred to the separate earnings fund. Once those monies are in the separate earnings fund, please recognize that the earnings fund will be fairly sizable because it also includes unrealized gains. So it will be a fairly large amount, which is advantageous, I think. But either way, the amount that could be spent from that separate earnings fund in any one year is marked at 8% under this language, 8% of the permanent mineral trust fund's average or market value. There are two exceptions to that. One, to make distributions back into the permanent mineral trust fund, in other words, to grow the corpus, et cetera, and to pay administrative expenses the administrative expenses of investing. That's consistent with some other constitutions, including the Constitution of Idaho that we modeled this off of. The 8%, I'm going to leave that, it's a policy decision. I'm going to leave that for your discussions, but I can say this, the 8% policy, the 8% spending limit is intended to be a limit that can apply over a longer period of time than a couple of years. This is under the understanding that the market conditions and the investment and economic conditions that exist today are going to be different than they are 10 or 15 or 25 years from now. If this committee or the legislature chooses to put a spending limit in the Constitution, it's got to be a spending limit that can accommodate circumstances that are different than they are today. So I don't know, I can't explain the magic to 8 versus 9 versus 5, but I think that's a consideration that this committee has to have. If they want to put a spending limit in the Constitution, it's got to be one that will accommodate a very wide band of economic situations. Another thing about that 8% limit, some of the initial drafts of this constitutional amendment had, would put it at 5% of the 5-year rolling market average, consistent with our current spending limits. We, in consultation with the chairman and with Representative Harshman and some others, loosened that up for the purposes of allowing some flexibility over the time. Utah right now has a 4% spending limit in their constitution, but Idaho uses language, Utah uses language that simply says 4% as defined by the legislature, as determined by the legislature. And they have in their statutory law taken it upon themselves to change the time period over which that market value is measured. And by doing that, then they get some flexibility in their spending and they can better respond to different economic situations. So that's the complicated policy decision for all of you to make, but I would encourage that in constitutional language, whatever decision you make, if you're going to have a spending limit, I would try to make it one that can accommodate a lot of different economic circumstances. The end of this amendment retains the pre-existing authorization to make loans to political subdivisions, but then similar to the loss provision above, we have always treated that obligation as if there are losses that result from those loan to subdivisions, we make them whole. And right now in statutory law, we have loss reserve accounts to provide to make up those losses. But our constitutional authority to do that has been, I think it's there, but it at least is not stated, it's ambiguous. So we've added this language at the very end of the amendment on page 3 that said the legislature shall prescribe by law the manner, means, and timing for supplying losses to the permanent fund from loans made to political subdivisions. Again, that just, it pins down our exact authority to operate these loss reserve accounts as we currently have in statute. So, Mr. Chairman, that's a pretty broad overview. And of course, I'm happy to answer questions if there are any.
Okay, let me just, I do just want to ask you a couple questions to make sure that I think I understand this, but let me ask it this way. So when we do this right now, every one of the things that we have in the Constitution that this amendment does, are we already prescribing those by the legislature is already prescribed in doing those very things, are they not?
Yes, Mr. Chairman, they are, with the exception of one thing, and that's the obvious thing, is that right now we're limited to income to meet our spending obligation, and this clearly makes that into the term income or all gains, which is a little broader. So we give ourselves a little more authority. But
we have for a significant period of time use the term earnings to encompass both gains, realized gains, income, dividends, rents, royalties, any source of basically any source of appreciation to the fund that's been realized. Is that correct? Mr. Chairman, that is correct. Right. Okay. All right. Thank you. So anyway, go ahead, members, your questions.
Mr. Chairman, this is Lloyd. So
go ahead.
So in reflecting back on that constitutional amendment we tried to run a couple of years ago to remove that 4% cap on for indebtedness to cities that failed. My question then is it required that we put an amount there, or could we defer that and say that that's to be determined by the legislature, and what's the pros and cons to doing that?
Mr. Chairman, Representative Larson, it's definitely not required to have a spending policy in the Constitution. We can either leave that silent, or we can certainly add language that would put that burden on the legislature. And in fact, that's something, of course, it's been silent in the past, and yet we've adopted spending policies. So we would have the authority to do it either way. The advantage of putting language in the Constitution would requiring us to adopt spending policies, and then it would be clear that the legislature is to set some limits on our ability to spend these permanent funds. So it would make sense. Again, it's a policy decision about whether you should or shouldn't have it in the Constitution. Idaho does not have it in their Constitution. Utah does have it in their Constitution. So I think it's a policy decision. But again, I think the challenge of putting it in a constitution is to come up with a number or a system that works over long periods of time. As Chairman Perkins mentioned, I mean, when interest rates were that high in the early 80s and now they're barely scraping 1%, it's hard to accommodate that in a constitution, particularly with a number. But that's a policy decision. But to answer your question directly, it is certainly not required or necessary to be in the Constitution.
So, Mr. Co-Chair and Representative Harshman, I'm curious, it seems to me that this would be easier to promote and to pass if we simply have the legislature set the spending policy versus put a number in the Constitution. So I'm curious what your respective positions are on that.
Representative Harshman, you want to go first? He asked you first.
Mr. Chairman, just I think just was put in there, I think because of our last meeting, it was, I think, expressed that they'd like, the committee would like to see that in the bill. I think regardless, it's as determined by the legislature, but the thoughts then working through this, when I first came in the legislature, it was 12% was our statutory spending policy and was ratcheted down. And so where do you put it? Didn't know. So we thought put it at 8 to be a ceiling. I personally think it's better without, and it's just one less thing to kind of confuse and fight about. And but that's my own thoughts on it. But anyway, that's a starting point for us.
And the only thing I would add is I think that's absolutely right. We were talking before we gavelled in today. We talked about, for those of us that are old enough to remember what it was like in the early 80s, late 70s and early 80s, as we had high inflation, interest rates were over 10%. It was not hard to get a 10%. I mean, past book savings were at 5.75%. And everybody thought, why in the world would we ever invest in past book savings at 5.75%? Now we would take that all day long and twice on Sunday. So what we do know is just in our span of our adulthood, we've seen wide swings where those are. Is 8% the right number? I have no idea. But right now as prescribed by the legislature has now prescribed those as 5% of the 5-year rolling average. Has been said much higher than that. We've had discussions, we've had step down where we stepped it down lower than that, but then we brought it back to 5% because the 5-year rolling average lowers that somewhere depending on how it's swinging. It lowers that. It typically lowers that down a little bit, maybe 0.5%. But I think the other thing that we were concerned about is we looked at the other thing that this bill does that's significantly different than what we do now is it actually takes and separates the corpus, if you will, even though that term's not used in the bill. We've used that in the legislature for decades. It separates the corpus into one account, the permanent account, and then separates everything else into this investment earnings account. And so we deal with those separate. We've seen a number of states doing that. Alaska has done that for years in their fund. But what that does is help us, one, to monitor corpus so we always understand what the corpus is. And of course, in the bills, we've got a constitutional contribution to the corpus of the permanent trust fund that happens every year. We also have, we've also designated the 1% severance tax account into this fund and to the common school from the land fund corpus. We designate that for a number of years in statute. So that account's going to continue to grow, plus it's going to grow in value, but this does separate out the gains from those accounts, the income from those accounts into a different account. Would allow it to all be invested however we do that, just like we do now. but it would provide a separation between those two and always allow us to identify and pull out the understand what the corpus is. The other side of it, and the reason I have that long-winded explanation is if you don't have some limitation, what that does, it opens up the entire expenditure of the investment account in any one year. The legislature could spend it all, and so this is an attempt to put some limit on that. But it does. You know, it's a matter of what the consensus would be, and if this bill moves forward, but what that ought to be and whether it ought to be in there or not. But it's just attempts to try and address some of the concerns that people had about moving this direction. And there's been some expression that they wanted some cap on the legislature, but it certainly doesn't have to be there. There's not necessarily one now.
So the spending policy, is it directed towards the earnings account or the corpus? And if it's just toward the smaller account, then does it need to be a slightly larger percentage because it's not going to be as large of an account?
Well, it's based upon the funds, the permanent funds market value measured on the first day of the fiscal year. So it's right now that's, you know, well, Ian, help us with that. As I thought about that, it would be the total fund, but if we cull that out, it'll cull out. Right now, we've got the fund is worth about between $8.5 billion, or between $8.5 and $9 billion, I think. And but that includes about $2 billion of unrealized capital gains. So it'd be 8% of the 7 billion number, if roughly, or is the way that's written now.
Mr. Chairman,
Ian?
you're right. So it's an important distinction. The 8% is based on the market value of the Permanent Mineral Trust Fund, not the earnings account. So it is the smaller of the two, and that certainly would then justify or indicate a higher percentage because it's based on the smaller fund. And it's important to recognize that according to this new formula for separating the corpus into its own fund while taking all earnings and putting that into the earnings fund, the corpus, the Permanent Mineral Trust Fund, will be a smaller amount because it doesn't include any unrealized gains.
So, Mr. Chairman.
Go ahead, Mr. Vice President.
So Ian, along that line then, so basically we're studying a cap, a maximum spending policy with that explanation based on both. So you're going to have this that's for the non-corpus money would be 8%, and then the corpus money would be 8%. Is that correct? So what would be this? What would be the spending policy that we have currently is 5%? I'm trying to figure out how we're going to segregate these funds, whether they're both going to have the exact same spending policy or not. Can you explain that, how that would work, Ian?
Mr. Chairman, yes, I think that's a really important distinction. So the corpus itself, the Permanent Mineral Trust Fund, doesn't need to, under this system, doesn't need to have a separate spending policy because monies are not individually spent from that corpus. Rather, they are just transferred to the earnings fund from which all spending occurs. So the only spending limits are applicable to the separate earnings fund. The corpus is simply there to be made whole. And then depending on what other statutory provisions were adopted, you can add inflation to that. You can make deposits back to the corpus, whatever. But otherwise, the corpus simply, and in this case, the Permanent Mineral Trust Fund will continue to receive its severance taxes and grow for that reason. But otherwise, all the earnings, all the expenditures, the earnings all go to the separate earnings fund, and it's only from that fund from which expenditures are met.
So, Mr. Chairman, if I can follow up with the question of that, one of the things that would be helpful on that is just to have that, like we currently do, is just have that schematic of those fund flows, what they currently are, and how this would work by putting this into an earnings account and then the spending policy coming out of that. I track what you're saying now, Ian, but I think it would be helpful to see actually how that schematic compares to what currently happens.
Ian?
Mr.
And
Chairman?
it also occurs to me that, so just to be clear, what happens is the 8%, there's two caps, there's two spending policy caps on this. One is the cap in statute that says it's 5% of the 8-year rolling average. But this separate cap would say, doesn't matter what that is, but in no event can that ever exceed 8% of the permanent of the corpus, basically. So there's a double cap on that. That's the first comment. Do I understand? Ian, that's how I understand. Is that correct?
Mr. Chairman, that is correct. And I think that's also important because the constitutional language we're adopting here would not prevent, and in fact may encourage the legislature to set spending policies just like they've done now. So the existing spending policies could remain. They just could never exceed 8%. So the one we have now could remain in statute. You might, may desire some tweaks to make the language clear, but that's exactly right. The existing types of spending policies at 5% of a 5-year rolling average are perfectly appropriate under this language.
So at least for now, because the 5% of that does not exceed 8% of the current value of the corpus. But the other side of that, I think, is important, is it does create an incentive to continue to actually make deposits or see that the corpus grows, because ultimately, if you never deposit back or grow the corpus other than what it does, ultimately you will come into a day when your 8% limit in the corpus, if you haven't continued to grow it, will significantly limit your ability to spend out of the earnings account, regardless of how they get. So, for example, I look at Alaska's fund from when we looked at from the Treasurers Conference. Their investment fund is now larger than their corpus. By having this in there, the one thing it does do is ultimately it will make you want to continue and force you to continue to increase your corpus. Otherwise, you'll end up with a significant, potentially a much slower growing and stagnant spending policy than you would otherwise have if you don't grow that fund. It's going to make you watch both the corpus and the investments both in order to manage your ability to spend appropriately and out of that account without endangering its growth. I think that's one other benefit. It does create an incentive to continue to deposit money into the into the corpus over time.
Mr. Chairman.
Yes, go ahead.
I would absolutely concur with everything you just said. I'm just cognizant of the fact that there's a significant number of members in the legislature that don't share our philosophy.
Mr. Chairman.
Everybody does.
Mr. Chairman.
Therein will lie the problem is we have a significant number of people that are less interested about the long-term view of trying to reduce the cost of government and much more cognizant of the fact that they would rather spend the money now than versus having to vote on a tax increase. And so consequently, I get it. I'm with you. I agree with everything you said. I don't know that we can convince the future legislatures that that's the appropriate long-term vision to do for the state of Wyoming. I'm afraid we're going to have a significant number of people are saying, why would I do that? Because if I do that, rather than spend it and don't build the corpus, then I don't have to vote on a tax increase. And so I think it's a pretty hard lift in the environment that we are right now. I'm with you 100%. I just don't know whether we got a majority of the legislature that would agree with that statement.
Well, and it's not just a majority, it's a 2/3, but thank you. I appreciate your candor. Representative Larson.
So thank you, Mr. Chairman. And as I contemplated that, putting that 8% in the Constitution, Ian, it seems to me that that's somewhat of as a safeguard that the legislature can't be a drunken sailor and spend it all in a session or two. And so I was wondering if any other state had put language in their Constitution that limited the amount the legislature could adjust that spending policy. So if it was initially set at 8%, the Constitution said that in any biennium it could only be adjusted upwards a maximum of X%, 1%, whatever that is, would still control some of that spending, and then every biennium if you could reevaluate that. But Is that in anybody else's language, and does that make sense?
Mr. Chairman, if Brian has some extra information on other states, I'll let him chime in as well. But I would say that, what we tried to do here was mimic or go off of Utah's constitution. Again, Idaho has chosen not to put a limit in. Utah has chosen to place a limit, but I'll read it to you. It's this simple. And it's this simple, I think, for a reason, so that they have flexibility. There simply says annual distributions from the permanent state school fund, which is this is their version, may not exceed 4% of the fund calculated as provided by statute. That is their spending limit. And it's interesting that they choose 4%, because I would anticipate that that's a conservative amount. Yet that simple language allows them to adjust statutory law to give them some flexibility. They use that term, calculated as provided by statute. And again, what they've done is they've gone in and changed, for example, how many years of a rolling average they're considering. They make it longer or shorter depending on economic conditions, which has given them some flexibility.
So I have a question, Mr. Co-Chair, and that is that, does it make more sense to put in language that bases the percentage on the prime rate or some number, so that if the prime rate all of a sudden, like in the late 70s and 80s, goes to 10% or 9%, then it would be 2 or 3 or 4% over prime or something of that effect, as opposed to so it's a flexible number based upon the economic environment at the time.
Mr. Chairman?
Go ahead, Representative Hicks.
Yeah, I've kind of gone through that same mental exercise. My concern with using the prime, I think we need to look at that index to something. I'm just cognizant of the fact that our economy in Wyoming sometimes is tracked just the opposite of what the prime interest rate is, given the nature of our revenue streams. And so I'm not saying I'm opposed to it one way or another. I like the concept indexing it somehow, that we would allow that index with the averaged over a period of time to be able to move. I just don't know if prime's the right one, and I'm just throwing that out.
Well, you know what, we do have some other people here that, if there's any other questions about the bill, we'll come back and discuss the bill more, but we do have some other people that I think want to be interested in commenting on that. I think we've got Josh, Kevin, Fleming, and Lay are all on attending today, and so if there's any other questions about the bill, if you understand the bill, great. Otherwise, Ian, would you rather do these in order, or because of the do one bill at a time, or would you rather why don't we just do one bill at a time and keep that? Because I think then the discussion will be very similar on the second bill, but why don't we just stay with this one bill? So if are there any other questions from the committee, and then let's take some comment on the bill.
Yeah,
Mr.
Mr. Chairman. Go ahead.
Yeah, Representative Halligan's hand has been raised for quite some time.
I'm not seeing Representative Halligan's hand. Oh, he's got not his real hand, his Zoom hand. Okay, sorry that Representative Halligan. Thank you, Senator Nethercutt. Go ahead. You're muted, Representative Halligan. You're still muted.
Okay, thank you, Mr. Chairman. I have a question how the unrealized capital gains that are put into the separate account, the earnings and investment account, how that money is spent. If it's unrealized, how are they going to spend that money? How do we do that?
You don't necessarily spend it. It's just credited to that account. The spending comes out of whatever's in that account, and based upon whatever the spending policy is. But right now there's $2 billion of unrealized gains. You've got, this year we've got all those unrealized gains. This year you've also had enough income and other realized gains that you're far in excess of the existing policy. But ultimately, if there's never, if a treasurer chose to never ever realize any gains, then the spending policy would force him to liquidate enough to satisfy the spending policy. Does that answer your question? I think, Ian or Brian, do you have any comments on Representative Helen's question?
Mr. Chairman, I do, and I think that's one of the most important elements of, that's the endowment model issue that we're talking about. And that is that by organizing it that way and crediting all gains to the fund from which expenditures must mean, it means that if the state does have $100 million obligation to pay, then it can pick from which investments it wants to liquidate to make those. I'm simplifying it, and I don't claim to be an accountant. Somebody better can answer that question. But in the broad scheme, that's the idea. All of a sudden, the assets that we hold and the investments are fungible. And we, rather than having to realize income, the narrow band of gains, which is called income, to meet our our spending obligations, all of a sudden we can pick from any of our realized or unrealized gains to make those expenditures. And it frees us up to keep the good investments and get rid of the bad ones. And I hope I haven't simplified it too much, because that's not my area of expertise, but that's my understanding of an endowment model. And that's the reason for going to this model.
And the only thing, I think the other clarification is that endowment model has not been put into statute yet. We don't have a bill before us that does that, but this would allow us to move in that direction. We also, when it comes to comments of Josh, Kevin, and Patrick, they can help us probably with some of that as well. But Representative Helen, and other questions?
That's the only question I had, Mr. Chairman. Still, it sounds different if we're going to have to sell, or if we're going to have to liquidate some of our investments in order to meet our expending requirements from that concept. Is that so? Is that correct?
That may be the case. In some years that may be the case. In some years it will not be the case. There'll have been more than enough income and realized gains that you would not have to do that. But I think Josh and Patrick can weigh in on that too here when we get to their comments. Any other? Let's see, Senator Hicks, you have your Zoom hand up.
Yeah, Mr. Chairman. So I got a question for Ian. If we go back to page 2, and you go down to the bottom with the new language, it says legislature shall prescribe by law the manner, means, and timing for supplying the losses to the permanent fund. And what would be helpful, if you could walk me through what we currently have in statute that does exactly that. For each one of those, the manner, the means. So if you can show me in statute where we have current losses in the permanent fund, that we restore those, and then the means and the timing, I think, is a critical component. So can you help me out with that?
Mr. Chairman, sure. I mean, the prime example is what was passed in Senate File 121, which is the statute 94108. And that is, among other things, a codification of the Meijer rule. And that's very important, because what it does is it says from which categories of gains we're going to realize and make whole losses, and from other categories that we're not. We differentiate between interest, dividends, and rents, from which are directly deposited, and there's even a timing component to that. That's in 108A1.
So,
as
Mr.
opposed,
Chairman, real quick, can you remind me what that timing component is?
yeah, shall be credited not later than at the end of the second month following each fiscal quarter. That applies to interest, dividends, and rents. All other gains, I'm sorry, I should be more precise. All other realized gains, because this system doesn't account for unrealized gains at all. It says other realized gains shall be credited as soon as practical after the end of the fiscal year, but not later than 90 days after the end of the fiscal year in which the earnings were realized. And then it says that those other realized earnings must realize any debits against the account or fund which exist as a result of realized investment losses. So this is the Meijer rule. And we adopted that in statute, and that's a policy determination that was made under Treasurer Meijer, the prior Treasurer Meijer, years ago, and that has been carried forward as initially a treasurer's policy, the way they were handling that, and now a statutory rule that is how we're going to do it. The language we've adopted here is simply for the purpose of making clear in our Constitution that that's permissible. I think it was permissible before that this pins it down. It says the legislature does get to determine the manner, timing, and method of making whole those losses.
So, Mr. Chairman, if I can, so you referenced earlier that you could actually make up those losses with the reserve account. Where is that? Do we currently have that in statute?
Well, that's part of our spending policy now. I'm sorry, losses, I shouldn't say. I mean, right now our spending policy has the 150% tip back to the permanent funds. That's for the purpose of potentially inflation proofing, et cetera. Losses aren't, that is the loss provision right now that's handled. Otherwise, the interpretation of the legislature's historical contributions back into a corpus, it's not clear why those were made. Are those made for inflation proofing? Are they made just to grow the corpus for purposes of future beneficiaries? So the legislature has historically made distributions back into the corpus, but the exact purpose of that is not clear in the law that was passed to do that.
Yeah, so, and I understand that, but I'm getting back to, so what happens if we go into a situation, because I don't see in statutes where it says that we have to do that. You're right. We've done that in the past for various reasons. Maybe it was to recoup losses. Maybe it was for intergenerational wealth transfer. Maybe it's because we had $1 billion surplus and we just decided to put money in there. But I don't see in statute where that's a requirement to do that. So what happens when we get even under the Meijer rule and we have a 40% correction and a loss under the Meijer rule? We just wouldn't realize any funds available for, and I'm assuming the way this is conceptually structured under the Meijer rule, it's across all assets class. So it's the entire fund, not just the asset class that we may have had a substantial loss in. Is it the entire fund, or is it just that asset class or that investment fund that we had, say it was in commodities or equities or real estate or some other investment strategy? It's across all strategies, but I'm still trying to get back to how in statutes that it would require a substantial contribution out of the reserve accounts or the LSRA or any other thing to make up for the losses. So am I incorrect in saying that the only mechanism now that we currently have in statute is the Meijer rule? That's a lot, but.
Mr. Chairman, I guess first of all, I won't comment on the asset classes to which the losses are accounted, because I don't know how that's handled. That's much better handled by the folks who do that. So I'll let them answer that question. I think you're right in that the statutes do not currently dictate the way we make whole losses. All there is a constitutional provision that says that the fund shall remain inviolate. And I think that would be the policy choice that this committee and the legislature needs to make, because we haven't handled it in statute. I think that the treasurer's office has initially adopted a rule, and now that's in statute, but there are some questions about the proper way for doing that because it is not handled anywhere right now. It's the Meijer rule, and that's worked. But I think your comment is right. The statutes do not dictate currently how that's handled.
So I can give you an example. If you go to Idaho, now that they've made their constitutional amendment, they now have in statute that has to be repaid. It has to be those losses have to be restored within 10 years. So so what their legislature did is they went and took their obligation to deal with these losses and set a time limit. It had to be in 10 years. My experience under the Meijer rule is we've always done that within 3 years, I believe. And, but the reason for the Meijer rule initially was just as you said, Senator Hicks, was you were looking at that. If you had to restore all losses immediately, there would be years in which there is zero income or zero distributions made out of these funds. And so what happens is that those exacerbate downturns often, not always, but depends on the timing, but those often exacerbate downturns. So when you actually need the income the most, you may not have any if you're required to restore immediate losses. And so that's when Treasurer Joe Meijer set that rule before, just to make it clear. Was because we were all wrestling with how to deal with that. I think it was in the 2009 downturn is when that really became apparent, and that's when that rule came forward.
So can I ask a hypothetical question, Mr. Chairman? And I'm just trying to look
Vice
at
President. You're the Vice President. You can ask whatever you want.
Mr. Chairman, you're the chairman of the committee and you overrank me. So I'm looking out and saying, so hypothetically, if we look at our structure and if we went this way, and I've always been intrigued to do this because I think there's a lot of opportunity. But if we went this way, wouldn't it be prudent then that we would take, say, all the funds in the LSRA and the reserves account, and then just move them into this arena to allow for that? Or how do you envision if we did this? So when the constitutional amendment passes, we are now starting to use this sub-account as an endowment model. Wouldn't it behoove us then to try to just move all of the funds into the LSRA into this account?
Ultimately, I mean, that's when we talk about the endowment model, that's obviously one of the purposes is we have so many different accounts that have these kind of different purposes, and that impedes the ability of the investment folks to invest those to obtain the best return that they can, because they have a number of responsibilities and obligations with respect to reserve accounts versus corpus versus other things. And so one of the ideas behind this whole effort moving forward, and we get to talk about a lot more before we actually get there, but is to create that kind of total return concept where we allow the investment people to invest in the best total return rather than particularly chase income or any particular element that they need to sustain the purposes of the fund, but allows them to go achieve a total return. And ultimately, that would generally obligate or allow you to invest things that would, over the long haul, over both the near and long term, or both probably the mid and long term, result in a higher return to the fund overall, and the ability to have a more level spending level as that's appropriate for the size of the fund and the purpose of the fund. So you're right, Mr. Vice President.
Mr. Chairman, can I ask to see if our co-chair agrees with that? Bob, I'd like you to weigh in on that, please.
No, I would agree. I think it's a gradual transition, particularly just because of the way that we operate. But ultimately, and we would decide which funds and how statutorily and how that progression goes as part of our development of this concept.
Thank you.
So are there other questions? Or if there's not other questions, I'd like to go ahead and open it up for some comment by some of our other attendees. I don't see any other hands. So we've got Mr. Fleming, Mr. Lay, we've got Lisa on there from the Treasurer STO's office. Any of you like to comment? Patrick, you want to start with you first?
Thank you, Mr. Chairman, members of the committee. My name is Patrick Fleming. I am the CIO for the Treasurer's Office. Just a couple things that I would like to comment. When you talk about the endowment model, I would like to clarify that this is more of a modified endowment model. And the big thing that the endowments are able to do is spend their corpus. So that is why this other part of what we're talking about is so very important, because the pure endowments, they don't really care. They just spend, if they have a loss, they just spend it down. It doesn't matter. But what Senator Hicks commented on, I think, is extremely important to look at, because what this bill does not specify is, would the Meijer rule, would this negate the Meijer rule? And Josh can comment on this better than I. He knows both Idaho and Utah very well. But I believe one of their models, or one of the way they do it, is if you do have the market value drop below the cost value, so you don't have this excess reserves, then they will not be able to spend anything. And that, to me, is not attainable for what we are doing here. It would be very difficult to be able to do that. So in that instance, you would still want to have the Meijer rule in place, to where we would still be able to spend interest income, dividends, and then the realized gain portion would then go back into the account to try and get it back up to the market value or the cost value. So you would then be able to do it again. So they don't, historically, we haven't had this 10-year catch up, if you will. It's just the realized gains would then be, until you made it up, it could happen in a year or 2 years or 10 years. But that part would be very important. So in that case, if you passed a bill like this, there would be no situation that you would be worse off that I can envision, because we would then just go back to the way we do it right now. Conversely, if we do pass it, which to me this is one of the most important bills that I have seen and would be extremely important, then it gives us this flexibility to be able to meet the spending policies, because of the way we do it now is this archaic rule of only spending interest income. And historically, we've had bonds for all these years, and that's all we spend. And Mr. Chairman, you were talking about when interest rates were 22% and 15s were 15% for 30 years or whatever. We never had this concern. Now we have interest rates very low, so we're not able to have that same policy. Our asset allocation has changed from equities, or from fixed income, to equities and private equity and real estate and all these other assets that don't necessarily have interest income and dividends. So it's extremely important to be able to capture that capital gain and be able to use it to spend. And that's what I would say, that's what this bill does. The ability to spend that difference, I think, is extremely important. So I'll leave it there.
All right, thank you. Thank you, Patrick. Questions for Patrick? Anybody have questions for Mr. Fleming? Go ahead, Senator Hicks.
So Patrick, have you gone through an exercise where you've looked at this? And so let's assuming we adopted this and we took the current balance in the account, which was somewhere around 2 to 3 billion, I think, is the unrealized and realized capital gains that we did that. And we applied the Meijer rule, and assuming that we had a series of, say, a 10, a 20, and a 40% correction, which is a loss of that funds. And we, it's all going to be projections, actuarially looking at, what may happen in the future based on past results. But what would be the time frame then that we would, under different scenarios, that it would take to recoup those under the Meijer rule? And then back to my question to Ian earlier is the Meijer rule is an aggregate across all asset classes for the total in the fund, is my recollection. It's not just on an individual fund, but could you clarify that also?
Mr. Chairman, Senator, we've never had to introduce it, but the way that I have always looked at it is each fund is under the Meijer rule. So you would have the PMTF, Common School, et cetera. So if that fund dropped below its cost basis, then you would no longer be able to distribute interest income and dividends. But we could have, I know Don Williams and other people are on board here too that could clarify that. But that is how my understanding it would be. To get back to your first part of the question, let's just go through a hypothetical, because as you said, this is all projections. And so I cannot project whether we're going to have a V type of recovery, because that would be very, very different than a long drawn out recovery like what we had in 29 or the Japanese had in 89 and so forth, which is, 20 odd years. But in that instance, let's just go through the numbers. So right now, the cost basis on the PMTF is 7.8 billion. Let's just round that off. The market value is 9.5. That gives you $1.7 billion that you have in this difference between these accounts, cost basis and market. Then the key component of this is the spending. So it is very different under a 5% spend versus an 8% spend. So you also have to consider what the current or our projected interest income and dividends would be. So right now, we're projecting around 228 million for this fiscal year in interest income and dividends. So that gives you kind of an example of how much that we would have in that scenario if we were not able to use the other dividends and interest income. So under scenario one, at an 8% spend, you would be at 758 million on the market value of the PMTF as of today. And then you have 228 in the projected income from Craig. So that brings you down to 530 million. So in that scenario, you would have 530 million versus a 1.7 differential between cost and market. Have I confused anyone? Are we good so far? So in that, went back to your question, how many years would you have and how much could you drop? Just pick your poison on it and say, 20, 30, 50%. The last two big markets that we've had is a 34% correction in equities, a 50 and a 58%. So we wouldn't have that of the total PMF, but you'd have a big chunk of those realized gains, unrealized gains that would disappear in that scenario. Now at a 5% spend, you just take the difference and you can calculate it that way. But in that scenario, if we did do this, there's two different components. It also would free us up to take the reserve accounts, because right now the reserve accounts are just sitting in cash. And so now we could take the reserve accounts and put them into the same asset allocation of the total fund.
Mm-hmm.
So the amount of income that we'd be able to produce would be significant. The differential between you just take the 5-year numbers that we've had, for instance. As we know, Common School has a 5% mandatory spend where the PMTF does not. So we have a higher allocation to fixed income in that account. Over the last 5 years, that has resulted in a 1.3% lower yield. If you take the 1.3% at the current Common School of 4 odd, that equates to around 300 million in less income if we were able to invest it the same way as the PMTF.
So, Mr. Chairman, a follow-up question on that, Patrick, would be, so if we did use the reserve account, I think we would want to roll these in there, but currently the way that's structured is because we have guarantees that come out of there on the reserve account. We got to get rid of those guarantees. We got a guarantee on the reserve account right now to the school capital construction account. And as long as those guarantees exist, it would preclude you from being able to invest in those higher yield return items because of that guarantee. Is that correct?
Mr. Chairman, Senator, I'll leave the guarantees up to you of however you do it. Don't want to comment on that. But how we look at it is what we need to be able to take the money out of the state agency pool, which is just a cash account. It's earning 25 basis points right now, is how many years of spend can we have? So if we know what the liability is, then I can set up the asset allocation to match that, tenor match the assets and the liabilities. So what we basically will need, theory says around 5 years of a spend. So if we're able to have that 5 years of the spend, then we would be able to free up those lower yielding assets to put it into the same asset allocation. So if you have, like the Lizer has loan, all these different loans and things that you have done to take away that. If that takes away the certainty of how much we'll have, then we would not be able to put as much of the assets into the same asset allocation that we would. So to answer your question, you tell me how much we have, and I will be able to put through an asset allocation. So, but until I know those numbers, if you're telling me it's an 8% spend, then I will have a different asset allocation than a 4% spend, because I'll have so many more years of reserve to put it in. So that those numbers, you tell me what it is, and I can come up with an asset allocation.
And to do that, Mr. Chairman, we'd also have to tell you what those restrictions and the guarantees and all that stuff out to make that asset allocation across, right? To try to achieve a higher return. In other words, if we're going to backstop all this, it directs what you can actually invest. So if we provided a guarantee, whether it's out of the LSRA or whatever that account, it limits your ability to achieve those higher returns, because you have to have that cash on hand in case of a downturn. I'm asking the question, Patrick.
I'm sorry, ask the question again. I lost the question.
So the question is based on what you just said, is it says the more restrictions that we put on those accounts limits your ability to achieve higher returns.
That is correct. And one other comment, Mr. Chairman and members of the committee, when you talked about changing the spending policy to relate to a whatever rate you want, what we're doing right now is we take the asset allocation to match the spending policy. If you're telling me that it's going to be if you will, index is a rate, then that will be a very different asset allocation that we would have to put forth. And again, that then will take us right back to where we are now, to where we're focusing on fixed income instead of total return. So the whole reason why we do this on the moving average, and I think Ian did a great job of explaining, because the way I read this right now, that 8% is only on a 1-year basis. If you do it on a 3-year basis or a 5-year basis as the fund grows, then obviously you're going to be adjusting that number. So depending on how many years of a rolling average you put, what the rate would be, and so forth, those are all the types of information that we'd need to know to be able to come up with the optimal asset allocation. But right now, we're taking the rolling average of the total market value of the fund. So as that fund grows, if interest rates go up and we could get more income, that fund should grow and you'd still be able to get a portion of that. So my personal take is that you wouldn't necessarily need to change the rolling average of what you're using, that the rolling average of the total market value or whatever single year, whatever you use, would be sufficient to be able to fulfill the spending policy.
All right, thank you, Patrick.
All right, thank you. Any other questions for Patrick? I see, Mr. Treasurer, I see you're there. I'm sorry I didn't see you before. I would have had you speak first. Mr. Treasurer, you've got your hand up. We're glad to have you today.
Yeah, Mr. Chairman, I'll just make a couple of comments, but I think I'll wait till Josh and some of the other ones go to make some finishing comments. But, Patrick just said that, all we have to do, am I muted?
No, we can hear you.
Okay, I saw a mute there, and so I wanted to double check. That all we have to do is he'll get an asset allocation. Well, if you're going to get 8%, then you guys are probably going to have to change that 70-30 to probably 85 or 90% stocks and 10% fixed income to get an 8%. And then you also have to realize that when that extra risk goes in there, the chances of having that 30-40% correction also goes up.
Well,
So
just Mr. Treasurer,
much.
Right, Mr. Treasurer, the 8% is just a limit. Right now, the statute is still the 5% of the 5-year rolling average, and all that just presents an upper limit so that to prevent a future legislature from going too far afield. It does not change. This bill, if it went out and the people passed this as a constitutional amendment, it doesn't say we're going to have an 8%. It says the maximum you can ever have out of the spend out of that one account is that upper limit. It doesn't set a spending limit in statute. It does present an upper limit, but it's not going to by itself change the current.
Yes, certainly. I understand that. I'm just giving you guys a warning. There's no free lunch.
Yeah.
Then another state that had a and still does have a constitutional limit was New Mexico. They started out at 4%, and there was some concern that wasn't enough, and so they went back with another constitutional amendment that just amended it back up to 5. So it's not like what you start with is set in stone. It's harder to change, but and then I think there's something that looking at this, you've got the legislature getting really involved in a lot of investment decisions, and almost on a day-to-day basis it could be. And I'm
could you, Mr. Treasurer, could you explain that? I don't get that out of the bill. I don't see.
Yeah. I just
much more.
that everything is basically prescribed by the legislature. In the caution I say is that whereas the slip board is bound by the prudent investor rule in developing our investment policy, and so is the treasurer's office. The legislature necessarily isn't bound by the prudent investor rule, and I think that's anyway, anything can happen in the legislative process, and it has. So I think that in areas I would say where the slip board might be able to make some decisions or offer some guidance to the process, that you think about whether or not they may in some areas be able to have I guess a better grasp of the issue at hand. But I'm going to I guess turn it over to back to you, Mr. Chairman. I've got a lot of proposed amendments here, or some questions, but I'd like to hear from Josh. I think he has a way to inflation proof and get money back into the corpus that some of these other states have used, rather than our reserve fund and tip model that he could do a better job explaining than I could.
All right, thank you, Mr. Treasurer. If there's not any questions for Mr. Treasurer, we'll go to Josh. Josh?
Thank you, Mr. Chairman, and members of the committee. Josh Keevan with RBK. I just had a couple of comments, and I think the first and most important is I applaud you for taking up this issue. I think this is a critically important piece of legislation. In terms of how important it is, I'm reminded of the opportunity cost study that you asked LSO to produce, and Polly Scott did some really good work on that. And if you remember back to that, it showed what the returns of the main Wyoming permanent funds have been over, I believe, the past 20 years versus what the median endowment and foundation had returned. And I don't recall the exact delta, but it was significant. And it has the potential to be even more significant because the funds are much larger now than they were 20 years ago. So freeing up the flexibility of the investment portfolio to pursue total returns without this need to focus on the composition of the returns, from my perspective, has the potential to add multiple billions of dollars to Wyoming's wealth over the next 15 to 20 years. So that's point number one, is this is really, really important. And I'm just thrilled to see this draft legislation at this point. My one note of caution that I would offer you on this is that I think Patrick is correct to describe this as modified endowment. And anything that stops short of pure endowment meaning you just spend the spending policy and you're indifferent to whether you're above or below corpus value. And just to give you a couple of examples, New Mexico is one. New Mexico has gone to that model. They have in their constitution a 5% spending policy for both their school fund and their severance tax fund. North Dakota has also done it for their school fund. Their severance tax fund is newer and has some different rules around it. But this is how most university endowments would function today. Anything that stops short of that has the potential to run into issues. When you talk to the folks in Utah and Idaho that run their investment programs today, they would note that there is still an extreme market event scenario that they worry about, even with their models. Now, their models are a significant and positive move, from my perspective, in the right direction. And I think your staff is correct to focus on those two. As it relates to the sort of modified endowment models, I've looked at a lot of these. Those are two of the more thoughtful ones in terms of structuring this to work under most scenarios. But I would just caution that there are still potential scenarios where you end up in a situation where your earnings are depleted and your market value dips below corpus. And in their cases, as Patrick noted, they just wouldn't be able to spend. So you got to come up with the money somewhere else to be able to spend. As it relates to the different modified endowment models, I actually see in the draft legislation, sort of elements of both of those, as I think was noted, as well as maybe a little bit of Alaska. Those are really just, as I think was noted earlier, policy choices. And I'd be happy to comment on or answer any questions you have on those various policy choices as best as I can. It does seem to me that there's possibly still a way to simplify, and I think the simpler that this can be, the better. Little examples like sort of still describing realized and unrealized earnings, moving away from that kind of language towards concepts such as total return, which really encompasses all forms of gain. But those are littler things on the margin, and really reflect policy choices that are not my purview. As it relates to the spending cap, I understand exactly what you're saying, Chairman, that this is not the spending policy. Spending policy is in statute. And the spending cap is potentially a good idea, because as you move away from the income-only spending model, this is what potentially provides some comfort to the eventual voters on this, that your surplus won't all be distributed too quickly. It may not necessarily be necessary from the standpoint of this draft still says that the corpus shall remain inviolate. So nothing really changes if you leave that out from where you are today. But when you think about spending caps and spending policies, I think two things are important. One is sustainability of the amount. Most would suggest that not just in today's environment, but over most environments, 8% of the current value has a high probability of being an unsustainable spending amount. Historically, 5% of some trailing average has been most common. Many have moved lower than that in today's environment, but that has been the most common historical standard. I have done a little bit of just real simple modeling of what happens if you don't do this as a percentage. and or as a trailing sort of average. And I think that trailing average piece is also really, really important to this both ways, because if the portfolio is increasing or if the portfolio is decreasing, that gives you some more certainty as to what that amount can be. So I believe that gets me through my notes on that. Oh, I said there's two things. One is the sustainability of the amount. The second point is that importance of doing it over some rolling period. I think that is an important concept. Is when you get into the modeling of this, that does tend to matter. So, Mr. Chairman, thanks for the opportunity to make a few comments on this. I will stand by for questions that you have for me now or throughout this discussion.
Mr.
All right,
Coach,
thank you.
So-
Thank you, Josh. Go ahead, Mr. Co-Chair. Ms. Vice
Josh,
Chair.
the question would be, does it make sense to put it in a constitutional amendment versus having the spending cap or spending policy statutory set, so that if there is a major correction or some catastrophic event, we don't have to have a constitutional change to find a way home, basically?
Mr. Chairman, Vice Chairman Nicholas, I feel like that is getting into policy choices. As an investment person, my bias would be limit the spending to a sustainable amount, however that's best achieved. I think, the difference between it being in statute versus the Constitution, obviously, is the statute is very easy to change.
Okay, Mr. Vice Chair, is that anything else? Okay, Representative Obermuller.
Thank you, Mr. Chairman. Josh, I'm a little slow on the uptake on why this bill is great from an investment standpoint, absent changes at the statutory level, just as a standalone bill. Tell me again why this is a great idea just as a standalone
Mr.
idea.
Chairman, Representative Obermuller, the way that your Constitution currently reads requires that all income is distributed, and it requires that only income can fund the spending policy amount. A spending policy amount is what's currently in your statutes, and by Constitution, it can only be funded from income. Now, income means something very specific. It means interest, dividends, and realized gains, rental income. And the effect of that is it forces the investors to pay a lot of attention to how much of the total return is income. It can cause an overly conservative asset allocation by focusing on income as opposed to appreciation. It can restrict the use of certain tools that can be very efficient sort of tools for the staff to use. And by that, I mean, the retirement system utilizes a futures-based rebalancing tool, where instead of having to sell assets, they have an agent that uses futures contracts to sort of keep them in line with their investment policy. That's an efficient and way to implement rebalancing. The state treasurer's office really can't do things like that because the nature of those futures contracts is they're short term, and they have the potential to introduce realized losses that you can't control. And the other thing, just as it relates to the asset allocation and the risk taking in the portfolio, achieving higher long-term returns requires investing in assets that get more of their return from appreciation, but have more volatility from one year to the next. And you may be in a situation where you have an investment manager that is invested in equity securities, and the market drops, and they find out some new piece of information that makes them think that, you know what, even though that company is lost money for us, we want to sell it now. We think the best investment decision, the best way to maximize future economic value is to sell it now before it gets worse. And under your current construct, that creates a realized loss, and that realized loss creates a hole that is problematic. And so because the investment program has to sort of be respectful and fearful of that today, it influences asset allocation choices, and on the margin, it can skew towards too conservative of an investment portfolio. For what is otherwise, you have a tremendous endowment, a tremendous sort of natural advantage, and that you have a very long time horizon. These are permanent funds. They're intended to exist across generations. And you should want to take advantage of that from our perspective as much as possible to maximize the wealth for the future. So hopefully that's responsive to your question.
I'll follow it, Mr. Chairman.
Go ahead.
From your comments, it sounded like you were more in favor of a standard endowment model rather than a modified one. And so I'd like you to address that. And the other piece is under what you've described, somehow it gets back to what Representative Hallinan was asking about, is how do you distribute unrealized gains if that's the scenario that comes up in order to meet a spending policy, and you have to distribute something beyond dividends and interest, and you have no capital gains. Presumably there's a distribution of unrealized, and so how does that work under the modified scenario? Thank you.
Thank you, Mr. Chairman, Representative Obermueller. Great questions. And back, I'll start with the second question, which goes back to Representative Hallinan's question. And Chairman Perkins is exactly right. Under this, if you move away from this constitutional sort of pointing at income as the only way that you can fund your spending policy, you have to separate in your mind the two different concepts. One concept is, do you have value in your portfolio that's above the corpus value? And if the answer is yes, that can be distributed. That becomes a completely separate concept from how much of that value came to you in the form of interest or realized gains or unrealized gains. And in fact, I'll try to kind of just give you a real simple example here. Let's say you've got a corpus value of $100 that you invest in two stocks, stock A and stock B. And let's say that stock A, both of them you buy at $10. You buy 5 shares. So you've got 5 shares of stock A at $10. You got 5 shares of stock B at $10. Well, let's say in year one, you have a 20% gain on those two stocks, but you've got a small loss on stock A and a big gain on stock B. And let's say you decide that, you know what, we were wrong about stock A. We want to sell it, and we want to sell it at a loss. We want to sell it at a loss, but the total portfolio has a 20% gain because stock B did so well. You can sell stock A, realize a loss to fund your spending policy. And the only thing that you really care about here is the fact that the portfolio is worth $120, which is more than $100. So $20 is your distributable income in this simple example. And you really don't care how many shares of stock A or stock B you sell to fund that spending policy amount. Is that helpful for that particular question?
Mr. Chairman.
Go ahead.
Josh, in your example, just that you just stated with the capital loss, are you suggesting in that scenario that the amount that you sold it for is available for distribution? That sounds like a distribution of corpus to me.
Mr. Chairman, Representative Overmuller, you have to sell something. You can't send your transfer stock to your beneficiaries. You have to sell something to raise cash. And corpus is not, in this case, it is not tied to a specific security. It is a value. It is the value of everything that's been deposited into the account over time. And you account for that value. And that is exactly how Utah and Idaho are doing this under this modified endowment model. And it would be the same as what's represented in this draft legislation.
Thank you,
Okay.
Mr. Chairman. Thank you, Josh.
Thank you. Let's go, I think, looking around, Mr. Lay, did Mr. Lay, did you want to jump in? We haven't heard from you today. Mr. Lay is part of our IFs, one of the members of the Investment Funds Committee. Mr. Lay?
Yeah, thank you, Mr. Chairman and Mr. Vice Chairman, and it's good to see everyone. I just wanted to, I don't have anything to add to what Josh and Patrick have been explaining. I was very, I joined Josh in congratulating you on moving in this direction, because I think that, as he indicated, the opportunity cost for the state of not moving in toward this endowment model has been and would continue to be quite high. I think, and I think the discussion's been quite good about some of the, we need to avoid constraints on the investment team's ability to respond to changing market conditions, to diversify investments, and so forth. And I think the more of the I guess I'd call them historical limitations that have been placed on the process that we can sort out and take care of, the better. So that's all I would say, because I think Josh and Patrick have addressed the specific questions quite thoroughly.
Thank you, Ken. Appreciate your attendance today. Any other, Patrick, you had your hand up for a little while, and did you have anything else that you wanted to say?
Thank you, Mr. Chairman. No, I just wanted Josh to comment on Representative Haldenham's comments about how it actually works,
Right.
because he works with
Right.
Idaho and Utah. Thank you.
Thank you. And yeah, I mean, so I think it really is the cash management portion of all this is significantly different and a different concept than the investment side. And so, yeah, anyway, I appreciate your comments on that. Any other questions for anything else? Go ahead, Mr. Lay.
Yeah, on the cash management issue, and this will, I'm sure, will seem to some like restating the obvious, but I think in managing any pension fund or endowment fund, when we know that there are going to be cash withdrawals that are going to be necessary for various expenditures, that gets taken into account in the asset allocation, and it's part of the optimization of the asset allocation. And so I think that's just a key point. I know, again, it's going to seem like a restatement of the obvious to many, but the key point here, I think, is to ensure that the state has the full toolkit to manage these investments optimally, and taking into account the cash requirements that it may have. Endowments all over as everybody knows, endowments routinely are being asked for some percentage of their total value every year. I've seen some go through periods when I can recall the Norway fund lost, 20% in 2008, and nevertheless was still in a position to make payments to the legislature and then rebuild the fund as the market recovered. And I think, so I do think that I do think that this is it's a very conventional part of the management of any kind of endowment, whether it's for charities or universities or for long-term for providing supplements to the budget of a government over the long run. So I just would make that point on the cash discussion.
Thank you, Ken. Appreciate it.
Mr. Co-Chair.
Mr. Vice Chair.
So the one question that Patrick and Ken and Josh did not answer is, if we put a cap in the Constitution and set a numerical amount, what is a reasonable place to put that won't require another constitutional amendment if there is a like a typical correction like Patrick talked about earlier, between 35 or 40%, so that we can still cover our spending policies and recoup the funds in a reasonable time frame. I mean, how do we establish that number, and what would it be if you were the king? What would you set it at?
Mr. Chairman, Representative Nicholas, I'll give you my answer first, and then let Patrick and Ken let you know what they think of my answer. From my perspective, there's a good reason that 5% has been established as the most common spending policy historically for endowments and foundations. So I'd suggest 5%, and that's 5% of the total value of corpus and the earnings reserve. I think when you get into having it only be one component of it, it's getting complex. And the more you can reduce complexity, the better. So 5% of the total combined asset value, as measured over either a 3 or 5 year rolling average basis.
So, which actually the other question you might answer is how advisable is it that you have a spending limit at all in the Constitution? If you have one, maybe that's what it should be. Should you have one in the Constitution?
Mr. Chairman, I tried my best not to answer that question last time. I'll try again. It gets down to, from a policy standpoint, it's different being in the Constitution is different than being a statute. And it's just how sticky do you want it to be?
Mr. Chairman?
Okay. Yes, Senator Hicks.
It seems to me like maybe we're asking the wrong question here. Is we can set that cap with the rolling average, but the point that we're trying to get here is we all recognize that things are going to change at some point in time out into the future. So it seems to me what we need to ask ourselves is if we set that cap, whether it's 4 or 5% or whatever it is what we need to enshrine in the Constitution is the ability of the legislature under certain conditions to be able to adjust that percentage. And so I've got a little amendment prepared up, but I don't know when we would want to discuss that. But seriously, I think that's the issue that we're talking about here. The cap's important in the Constitution, but we have to foresee that cap is going to have implications, not just 4 years, 5 years, but 10 and 20 years down there. So if we know that, and why wouldn't we provide the mechanism in the Constitution to allow the legislature to adjust that percentage of that cap under some pretty stringent sideboards? And so it seems to me that ought to be part of this discussion. And I think that gets back to similarly, if I understood Josh, and I don't remember who else talked about, that's kind of what Idaho does, is allows, there's a cap in there, but they allows the legislature to adjust that. And I think that's a direction, at least in my mind, I think that we would want to go.
Okay, thank you. All right. Any other comments? Any other comments?
Mr. Chairman,
Go ahead, Lisa. Go ahead. Glad to have you.
thank you. This is Lisa Jordy Spillman, General Counsel for the State Treasurer's Office. First, thank you very much for this exciting proposed legislation and the hard work of the committee and your staff. Our office is very excited to see this. I just have two comments. The first is regarding the putting the Meijer rule into the Constitution. Your office has already, your body has already exercised the authority to incorporate the Meijer rule into statute. So we're not convinced that it needs to be in the Constitution at this time. The second point I just wanted to bring up was raised at the bottom of the bill addressing the changes to the Constitution for the Common School Fund, is that when the common school lands were granted, it was via the Enabling Act, and that act had strings attached, including language with respect to interest only can be spent. And if these constitutional amendments pass, there is, as was pointed out at the bottom of the bill, a potential for conflict. Other states have similarly amended their constitutional language and their statutes, and they have sought bills from federal Congress to incorporate those changes. There are differences in how the amendments were made in the states, and so there's differences in the changes to those enabling acts. Some of the states include New Mexico, North Dakota. The North Dakota Act, actually, they added a new section to their Enabling Act specifically for North Dakota that said that you can distribute based on how the North Dakota Constitution is set up. Utah made changes to theirs. Arizona made changes to theirs in a very similar way, striking the income-only language, or striking the interest-only language. So those are just some examples, and we may find that that is a second step that has to be made.
Right. Thank you for that. And we talked about that, and ultimately, if these move forward, we'll work with our congressional delegation to have similar changes or work on those changes to have because you're right. I mean, particularly with the not with the PMTF, but with the Common School Permanent Land Fund, Common School Permanent Account, those need to be changed, and it's a little bit of a chicken and egg. I think we have to move forward on all of them if we're going to move forward at all. I appreciate that, though. Thank you. And we've got please convey any information you have to LSO. I know our staff has been looking at that too, and we'd love to compare notes with you.
Thank you.
Thank you. Anyone else? Any other comments this morning? Is there anybody in the waiting room? Paul or Karen?
Mr. Chairman, we don't have anyone in the waiting room.
All right, Mr. Treasurer Meijer.
Yeah, thank you, Mr. Chairman. There was one thing that I had talked about to Josh. He didn't mention it on the inflation proofing or a way to grow the corpus, and essentially that you try to get your spending or your separate earnings fund up to 7 times the spending policy of like your average 5 years. And then after it gets to that level, you've got a big enough cushion that you can withstand about, any kind of downturn and not interrupt your flow, your continued flow. And then when it gets to that point, then if the fund grew appreciably large, you could tip that back into the corpus. Now, the reason that's important is that because you inflation-proof the fund, but you also inflation-proof the growth, basically, of the spending policy, because that's a factor of the total market value. So that way you can make sure that it doesn't get too large. Then there's in there where you say the earnings may be invested as prescribed by the legislature. I would just say that in the same manner of the permanent fund, because that's what we're planning on doing. I'm thinking that's what you would prescribe, but that puts it in there so there isn't any thing that gets off the rails, so you know how that will all function in the future. I think that's how Patrick described it. There are some other things that if I could necessarily wave my hand, there's been some things as far as just how much money we're going to give to the political subdivisions. I know this is a little bit off the topic, but if you could cap that at $1 billion, then you know that you would ensure that the spending policy would occur at a higher rate of return, and we wouldn't necessarily put all the money into political subdivisions at a low interest rate like we have now. So at least that gives you some level of comfort that in the future, most of the money is going to be invested as the regular permanent fund is, and isn't going to be sucked out by the political subdivisions. So that's something that you might contemplate. Are those 2 areas there or 3 areas there? One that I know has had some, I guess, some concerns in the past is that as you're taking this out of the permanent fund, out of the general fund, you really have it directed that constitutionally, I think it might be appropriate to say that spending policy is put in the general fund as a distribution as it was before, but make sure that it goes through the legislative appropriation process, because in the past we've gotten all of these different revenue streams going off of that, and it kind of interferes with the process of the appropriation. So you could appropriate it on an annual basis, and you could put that in the Constitution. I know that's fixing a problem that you may or may not think exists, because some people really like the tranches, the SIPA accounts and the different things. So that might be too problematic for you, but I think that you probably should think about putting that back into the general fund, because you don't really say where the spending policy is going to go. As it is now, you could put it all in capital construction. You could put it all in one place. And so I think at least putting it back in the general fund, that's one argument that we don't have to argue with the public about why did you take it out of the general fund and where's the money going. So it makes the sales pitch a little less problematic from the standpoint of the general public in that regard, if you don't change that. So those are just some of my observations, Mr. Chairman, but I would, I think, echo everybody else's relief that we've gotten this far so far, because it's another $60 million a year, going to education. And we know that there's a lot of times when that you need a lot more than 60 million, but at least this is one way to accomplish a heavy lift. So I applaud your guys' efforts. I hope we can get something that will actually fix a lot of problems if we can. And but the big one that we have to do is to get this modified endowment. So thank you.
All right, thank you, Mr. Treasurer. All right, any other public comment or comment today? Just go ahead, Josh.
Thank you, Mr. Chairman. Just to add to one of the things the treasurer noted, he is correct, and I don't know if this is in Idaho's constitution or in their statutes. I'd have to look that up. But they do cap the size of their earnings reserve fund, and this may be why they don't have a spending limit in their constitution. They cap at 7 years, so that essentially whatever the current spending policy amount is, the earnings reserve account, if it is in excess of 7 times that amount, the excess tips back to corpus. 2 other things worth noting, just for your information on the Idaho model. When they calculate every year how much is going from the main fund into the earnings reserve fund, they essentially calculate what the total return was in the prior year. They also calculate what inflation was in the prior year, and they only move over the amount that's in excess of inflation. So in a simple example, if inflation was 3% and you earned 7%, 4% flows to the earnings reserve and 3% is added to the value of corpus. Yes.
Josh, is that in their constitution, or is that how they prescribe those things by statute?
I was going to ask Ian if he happens to know. I know he's looked at, I believe he's looked at their constitution. That may be in their statutes, but that is how they currently operate that feature.
Chairman, that's correct. Interestingly, that's in the statute. Idaho has made an interesting decision, though. The 7%, they do have a tip to their corpus. That's after their earnings reserve account. You know, again, the corpus, all the earnings are transferred to an earnings reserve account. Once that earning reserve account is more than 7 times their expenditure, it tips back into the corpus, which Josh was correct in saying. It's interesting, though, Idaho has chosen not to put that into Constitution, and it's not even in their statutes. It's in their land board's rules, which is an interesting, they leave those tips to the land board's rules.
Thank you. Thank you, Mr. Chairman. That was all I had.
All right, thank you, Josh. Any other comments? Any other comments? Going once, going twice. All right, we'll go ahead and close off public comment. Committee, what's your pleasure?
Move the bill, Mr. Chairman.
Second.
Got a motion and a second, so we're on the bill. So we're either discussion or amendments on the bill. Go ahead, Senator Hick.
Mr. Chairman, we've got a couple of proposed amendments. I would like to start with page 3, line 8. Starting with the "in no event shall" would be to strike that from the balance of line 8, all of line 9, and line 10 through 8%. So, Mr. Chairman, and this won't necessarily track in exactly, but here's what I'd like to insert in there, that it should be 4% of the previous 5 years' averages would be the amount rather than 8%. And by a vote of 2/3 of the legislature, that could be adjusted through a spending policy not to exceed 1% during any one biennium. That's kind of the conceptual amendment, Mr. Chairman, and if I may, a little bit of reason behind that.
I'll second for discussion.
Okay, thank you, Mr. Chairman, Mr. Vice Chair, Co-Chair, Chair, whatever chair you want to be. So,
Barca Lounger.
You know, as I sit through this discussion, I think what I heard from the investment folks is the lower we reduce the spending policy, the higher rate of return we have, because it makes money available to invest in a broader range and potentially higher range of investments. I thought that I heard that. I'm also cognizant that we know that there'll be changes in time that may require more expenditures in the future. The reason I picked 2/3 vote of the legislature, because it takes 2/3 vote of the legislature to amend the Constitution. And I think if we're going to put in statutes a provision that allows the legislature to change a constitutional provision, whether it's 4%, 8%, or whatever that is, we need to have that same bar to be able to change that through a statutory provision that we've acknowledged in the Constitution. And so, Mr. Chairman, that's kind of the conceptual idea, is to move that to 4, but provide that language that that could be changed by 2/3 votes of the members of both houses, not to exceed 1% in any one biennium.
So I have a question. And that would be, one of the problems I see with this amendment is the 4% could or may work at some point in time when we are at a real total fund model. But until that time, I think it severely would tie our hands, and a 1% may not be near sufficient enough if we have a major correction next year. But we're only, we're very, the concept is we're going to move into this gradually, and we're going to have to build up the fund of the earnings fund to a sufficient amount that we have an amount that's sizable enough to have the flexibility to cover losses and to move forward and to cover our ongoing operations of government. So
Mr.
numbers
Chairman,
don't quite make sense to me.
so if I may, let me see if I can address some of those concerns. Under the scenario we have is this the 4%, and get to the issue of if we have significant. Number one, the 4% moves us here a lot faster. I think we would all acknowledge that by having a spending policy of only 4% of the total value of the assets. So you could actually invade the corpus under that 4% to do that. But the reason I think we would want to do this is it actually moves us quicker because of the ability to potentially invest in higher rates of return. But the answer to, I think, Co-Chair Nicholas's concerns of what happens if we have a market downturn. This doesn't contemplating moving the IRA into this investment strategy at this point in time. So you still have $1.7 billion as the current budget that we've projected by the end of this fiscal year, that we would have $1.7 billion in the LSRA. So under that scenario, we have more than adequate reserves in the LSRA to get us through a 4 or 5 year, 6, maybe 7 year downturn in the market. So what I'm concerned is if we're going to do this way, let's move that way. We've got the LSRA as a backstop for those downturns and those market conditions that allow us the flexibility to do that. So I guess, I don't know if that answers your question, Co-Chair Nicholas, but that's the way I would view that, the concern that you've expressed.
So Mr. Vice, we'll go to you, Senator, just a second, Senator Drew, and then to Representative Harshman. Senator Hicks, if I understood, I just want to clarify. What I understood was your proposal was just the base proposal. I understand the 2/3 majority to change it 1% per biennium. I understand that, but your base proposal was to set it at 4% at the 3-year rolling, the 3-year average. Is that what, if I remember right, was that what you said?
Correct. 4%
Okay.
of the 3-year rolling average.
All right, thank you. Senator Rue.
Thank you, Mr. Chairman. On and against, I agree with some of the principle involved here, but I guess when I read this on page 3 and that line about 8%, it says not to exceed 8%. And I heard, I think it was the good speaker, our former speaker, that said, that was for flexibility. And I understand the need for flexibility, but 4% to me is too constrictive. And the 2/3 vote to change 1%, I don't even think should be there. I mean, I'd be more willing to look at a 5% of the 5-year rolling average as a number. That could help us even it out, the good times versus the bad times versus, I think what Josh was saying about a significant event in the market that would change. I think that rolling average would help that. I like that part of the idea, but more like a 5% and not the 2/3 is where I'd sit. So I'm on against this. Thank you, Mr. Chairman.
Okay, Representative Harshman.
Thank you, Mr. Chairman. Members, I think I think the big difference between us and Idaho and Utah is we still have a very significant revenue stream going to this fund. We send basically 25% of the severance, and now with the 1% statutory, half of that, and it'll eventually be 2/3. We're about 35% of the severance actually goes to this fund to grow it each year. I think that's a huge deal, and that's really important. I think, but my question really for this whole concept, though, I hope we don't get hung up on this. And that's why I'm concerned about this whole spending policy amendment in this. I don't want this to hang up this whole policy choice. And when we get it in front of our colleagues. And so, I would hope we would take it out of there, frankly. But I think right now we have a 5% of the 5-year rolling average. Going back, I just looking at Polly's information she gave us last fall, that's really a 4% spending policy right now. And so we're in a pretty good spot, I think. And I think we can do that statutorily. My question, though, for the good Senator Hicks, you said that, if I heard you right, you said we could actually go into the corpus with your amendment. And I just don't see how we could do that. Because we don't change the inviolate nature of the corpus. And so I guess I just want a little clarification on that. Thank you, Mr. Chairman.
Good. Thank you, Senator Hicks.
So, Mr. Chairman, the concept is it's in this separate account that we set up. And so it's in the earnings account in there. So that moves that $1.7 billion that we currently have on the table. And so what we would do is take that $1.7 billion over there and put it in that sub account the way this is currently constructed, allow that to be invested in a total return philosophy. That 4% would be of the total value of that sub account that you could actually invade that if you needed to pay for that 4%. So the idea, getting back to the discussion that we've heard over and over from our RVK and Josh, and I think is this is a long-term horizon look. So by doing that, what I would anticipate that would allow our investment professionals to look at that, but to invest in those longer horizon things, and on the case of a severe downturn, to get back that we do have a revenue stream that we could potentially invade that corpus, that $1.7 billion in a separate fund if we needed to. And I think that's a concept that we should explore if we really want to guarantee that back for spending. And so I guess that was my concept. Under that $1.7 billion, under that, we would set that up that as prescribed, it would be 4% of the total asset or the market value would be available for expenditure, not just the 4% or 8% of the earnings on that. And that moves us more towards a pure endowment model. And unless I've heard something differently, that has the potential to generate a higher rate of return. And maybe I've missed something. So if I have, I would certainly ask for clarification from our investment professionals on that.
Okay. So if I understood what you said, when you're talking about 4%, you would also, you're including the 4% in determining the spending policy. So you would add in the 3-year rolling average would be not only be the PMTF, but also the LSRA. Is that what I understood, Senator?
No, Mr. Chairman, that's not correct. So let me see if I can find it in the bill where we go in and we take this. Basically, we're taking the difference between the let me see if I can find the right terminology, Mr. Chairman. So the difference between the market value today and what the actual corpus is. And so you take that was a $1.7 billion difference. And that would be the money that we would set up in this other account, correct?
Yeah.
Okay, under that scenario, the way I would envision this, that becomes the part that we would want to move towards the endowment model. Under that endowment model, I would like to see us set the spending policy lower, but allow us to be able to spend part of that $1.7 billion because of the long-term horizon, that the direction that we want to invest these funds. But it would guarantee that 4% out of the entire, in other words, it's not just the 4% of the investment earnings on the 1.7, it is moving towards a true endowment model on that portion. Does that clarify that, Mr. President?
Yes, thank you. I'm sorry, the 1.7, I thought you were referring back to, earlier you made a reference to about 1.7 in the LSRA, and that's where my confusion came from. So thank you for that.
Mr. Chairman, may I ask a clarifying question as well, just so I understand the amendment?
Sure.
Great. Senator Hicks. So I just want to make clear then, so the concept is to apply the 4% spending limit to the amounts that are in the new separate earnings fund. And I think that's consistent with what you said, because all earnings are put over into this separate fund. And then the 4%, right now the 8% applies to the actual value of the corpus. So this would change that to be a 4% rolling average of the 4% of the separate earnings fund, which does include all unearned and earned gains. Is that correct?
That is correct.
Okay. Thank you, Mr. Chairman.
Right. And I think just, and I don't know what that number is, but if we ran those numbers over the last 10 years, my guess is that since we're using it, if you're using a 3-year rolling average, it'll actually move it up a little bit above 4%. It'll, just like the 5-year rolling average rolled it down to of 5% of the 5-year rolling average rolled it down. I think the way in the last 3 years, the fund has increased significantly. So using the last 3 years, actually probably move it, it's going to exceed 4% of the 4-year rolling, the 5-year rolling average. So, we're probably somewhere in between the annual rate of returns, probably on the current market values, probably somewhere between 4.3 and 4.76% is what the net effect is if we kind of talk apples to apples compared to what we do now. So it's not that far apart, I don't think. So, but anyway, Ian, did you have a clarification or?
Yes, just one more question, just because this, of course, is important. So, and the 4% will not include any value of the corpus, correct? It's only the earnings that are transferred to the separate earnings fund.
Oh, no, the 4% is on the permanent fund plus the value of the earnings fund. So it's still the total value of the PM, what we have now, we consider the total value of the PMTF. It's still the total value of the PMTF, correct, Senator Hicks?
Well, that wasn't my initial, that's not what I was trying to do. So once we set up this separate account, which is the earnings account right now. And so I guess it's just terminology, Mr. Chairman. So it was not to have 4% to invade the corpus of our permanent fund.
No. Your spending policy is 4% of the sum of the corpus and just the total value of what the fund is for the last 3 years. That's the spending. It's 4% of that number. Is that correct?
Correct.
Right. Ian, does that get you? Does that clarify that for you now?
I think it does. So my interpretation, that is, it's 4% of the total value of both the fund and then the earnings fund. Sure.
Right. Okay. All right. Any other comments? Are ready for the question on the vote? Go ahead, Representative Schwartz.
Thank you, Mr. Chairman. I'm on and against this amendment, and when I started looking at this originally, I looked at this 8% is the critical piece of what we're doing today. And my only question was, do we even want to put that into a constitutional amendment? Because I'm not an investment analyst, I'm a politician. And what I'm looking at is what the language of a constitutional amendment will be and how it will be understood in order to get a 2/3 vote. And I am inclined towards simplicity in that effort. So I started out today thinking we didn't even want an 8% limitation. And that is something the legislature can manage through statute. I find this particular amendment to be overly restrictive and partly overly complicated, making the constitutional amendment more difficult to comprehend. So on and against.
All right, thank you. Other comments or other comments? Representative Harshman.
Mr. Chairman, just so I'm clear, because I've heard this and then I heard a clarification. So this amendment is 4% of the 3-year rolling average. Now, what I just heard was the entire of the market value. 4% of the 3-year average of the market value.
I'm seeing the Senator Hicks nod in agreement.
Okay. Yeah, and of course that'll be substantially less than what we have now, and that'll be less than anything we've had in the history of the permanent trust fund the last 50 years. And so I think this debate we're having should be the classic one for a statute change, another bill. Once hopefully this constitutional amendment is passed the 2/3 of the legislature and the vote of the people, then I think this is going to be the really important debate as we move forward and establish this in the legislature. So on and against this amendment, I'm also against really having this 8% in the Constitution. And again, just put it in there because the committee wanted to take a look at that at our last meeting. But I just think it's not proper to, have that in there for, 100 years down the road. Who knows? I think that's why you have elected legislators. But thank you, Mr. Chairman.
All right, we'll go back to Chairman or Vice Chairman Nicholas, and then we'll go back to Senator Hicks to wrap this up for us. Thank you.
So I'm a bit confused still because with this endowment model, two things will happen, I think. We'll take all of the current reserve accounts and incorporate them into the endowment. We'll take the LSRA and incorporate it into the endowment. So that actually increases the size of the total fund and any other dollars. And we'll probably take part of or a certain amount of even the pool A theoretically will be eventually drift into this account to a certain amount. We'll also, in all probability, be creating a new reserve account similar to what Idaho has that has a 7-year mark on it. So how that will be incorporated into this whole picture. It's my understanding, is that correct, Larry? That's where we're heading with this?
Well, just to clarify before we answer that, this constitutional amendment doesn't do any of that. That would all take.
Yeah, I realize that. Yeah.
Okay. So go ahead, Larry.
Yeah, I would concur with you, Mr. Chairman. That's all speculative. I don't know what future legislatures are going to roll anything into that account. That's my concern. I think that's what a lot of us share. But if I could just really quick address, I would concur to a certain degree with Representative Harshman. The 8% is very troubling to me. That was the reason that I brought the amendment. But to try to answer my colleague from Teton County, Representative Schwartz's question on the 8%. So I penciled this out, and I would ask if I'm incorrect that Josh can correct me. But what I heard him say was 8% is unsustainable. And what I further heard him say is 5% is common, and some of these funds are moving towards 4%. I also heard him said if he had to pick a number, that 5% might be reasonable. But because of the testimony that we've had here that 8% is unsustainable, I just can't support this bill in its current fashion with an 8%. And I understand it doesn't say 8% today, but it draws a cap on that. That doesn't mean that the legislature tomorrow couldn't do 8%. And so consequently, that 8%, it gives me a lot of heartburn based on the information that we've been provided by investment professionals today.
All right, thank you. So we're on the amendment, Senator Hicks proposed amendment. We're ready for the question on the amendment. Hearing so, all those in favor of the amendment, raise your hand. all those, okay, I count two. All those opposed to the amendment, raise your hand. I've got one,
Mr.
two.
Chairman, there was three, myself, Driscoll, and Hicks.
Okay, thank you. There was three. All right, and those opposed, raise your hand. I've got one, two, three, four, five, six. I count seven. All right, so that motion has failed. We're back on the bill. Are there any other amendments to the bill? Representative Harshman.
Mr. Chairman, I would just move that we take this whole spending policy discussion out of the constitutional amendment. And I'll leave it up to LSO staff to kind of clean that up. Maybe it's in a couple parts, but we'll just continue to do that as prescribed by the legislature.
Okay, there's a second from Representative Schwartz. Representative Hallinan. Did you have something? Were you seconding Representative
No,
Hallinan?
I was seconding that motion, Mr. Chairman.
Okay, we'll take your second instead of the other. We'll use your second, Representative Hallinan. Sorry, Representative Schwartz. So fine. All right. Are there other comments or other debate on this amendment? Thank you, Senator Hicks.
Yeah, Mr. Chairman, conceptually, I'm not necessarily opposed to the concept, but I'm opposed to the concept that then the legislature, with a majority of one person in each body, can then alter that spending policy. And that, quite frankly, gives me a little bit of heartburn. So without some provision that would require 2/3 of the members of the legislature to change that in the future, I can't support this.
So, Mr.
Right.
Butcher,
Go ahead, Vice Chairman.
I understand the Vice President's concern. And frankly, if once this endowment model is effectuated, I mean, the whole purpose of this is to grow the size of the corpus and to grow the size of the earnings account. And all we're going to need theoretically will be 4%, because the 4% will be the equivalent to 5% or even wherever we're at, because we're going to have a bigger fund and we're going to have more money to work with. And once again, though, once we implement it, and what's going to happen is this committee over the course of this summer is going to be working on that draft legislation that basically implements this process, so that if and when this constitutional amendment passes, then we'll have it all ready to go for next session. And so in that regard, I think that there will be more than ample opportunity for you and for us to figure out how and what number that should be, if it's 4% or whatever it is, and whether or not it's going to be incremental on as we implement the process, and to assure that we can't lackadaisically manipulate the spending policy. Because I agree with you with that. In fact, the testimony today was from both Patrick and Josh is that you can't, every time you tinker with the spending policy, they've got to adjust the asset allocation, and that just makes it everything more difficult. And essentially it requires more reserves. And so I think you're right. I just think that it's probably doesn't belong in having a stricture that just stands alone in this constitutional amendment. I just don't see how it can incorporate the correct number or the 2/3 vote before we know where we're at. So, or where we are, I should say. Thank you.
All right, are there any other comments on this particular motion or on this motion to remove the current language from the bill regarding the spending policy?
Question?
Mr. Chairman?
Question that.
Mr. Chairman, sorry, this is Ian. Again, if there's no other discussion, I just want to make sure, because I think I've heard two different things. Is the motion to remove the language entirely, or is the motion to remove the language and insert in its place a dictate that the legislature establish a spending policy or a spending cap?
Representative Harshman.
Mr. Chairman, really just want to remove that language on 8, 9, and 10, and then you'll have any cleanup on that. Currently, we set the spending policy, so maybe don't have to say that in there. But I want to continue basically the status quo where the legislature sets a spending policy.
And Mr. Chairman, I agree that the legislature, of course, does now set a spending policy, and the Constitution does not require it or otherwise address it. So that's right. It does not need to be in the Constitution in order to allow us to do that.
Okay. All right. So any other debate on the motion? All right. All those in favor of the motion, raise your hand. Got 1, 2, 3, 4, 5, 6, 7, 8. Okay, thank you. All those opposed, raise your hand. I see 1. All right, that motion has carried. All right, thank you. We're back on the bill. Are there any other motions? Are you ready for the question on the bill then? All
Mr.
right,
Chairman?
Ian? Yes, go ahead.
Mr. Chairman,
Go ahead, Representative Obermiller.
thank you, Mr. Chairman. Just a comment before we vote. I'm in favor of the general concept. I've been personally working on the idea of the endowment model for a couple years, but I'm against moving this one without a comprehensive approach to a statutory fix simultaneously. It doesn't make sense to me to add a level of complexity when the original purpose that I had in thinking about this was to simplify things, not to complicate things. So we're going to hit a spot with this where we've created an additional level of complication. Senator Hicks said, I'd like to see a schematic of this. I would too. I think there's a lot of things I don't even understand about this bill right now, particularly how it possibly invades the corpus. And so I'm not ready to vote for this bill in its present form. Thank you, Mr. Chairman.
All right, thank you. Is there any other, go ahead, Senator Hicks.
Mr. Chairman, I think in conversations that I've had with many of you on the committee, I think this is the right direction to go. But I have shared the same concerns as Representative Overmiller. I would like to see some comprehensive kind of direction. My concern is we're putting the cart in front of the horse here. I understand, co-chair, that we can come back and we can do all these things and debate them, but there's no guarantee that my concerns will be addressed in subsequent legislation, regarding spending policies. And in fact, that has been an absolute football for the last 3 or 4 bienniums. And I don't know that we've come to any cohesive agreement amongst the legislature as to what that should be. And given our past history of that, I'm a little reluctant to say, vote for this now and trust me later that we'll fix it in the legislature. And so I'm very concerned about not having a comprehensive plan. What my preference would be is to move some of those bills forward as part of this committee's work the next year and get that structure in place and then come back with the constitutional amendment. And I understand the ramifications of lost revenue associated with that. But Mr. Chairman, there's a reason we put things in the Constitution, and it's because we, as legislatures, feel so compelled that we actually do want to bind the hands of future legislators. This is why we have constitutions. And if we don't want to put the percentage in there today, I can't support a bill that says we'll fix it with the spending policy moving forward, and especially with the directives that we've heard over and over. Every time we change that spending policy, we screw up the investment portfolio and what they have to do. And consequently, I'm afraid that's exactly what's going to happen without some mechanism to make sure that it just doesn't take 50 plus 1% to change that spending policy moving forward, because it has been a political football. And so I would concur with Representative Overmiller on this point. Thank you, Mr. Chairman.
Okay, thank you. Any other comments? Go ahead, Representative Harshman.
Mr. Chairman, and really a question for you, Mr. Chairman. I guess I see this constitutional amendment as a first step, but I don't see anywhere in there where we change the inviolate nature of the corpus. That's why it's a modified endowment model, because that's our like foundation cornerstone. I think all of us, none of us are going to vote for anything where you could invade the corpus. At least I certainly wouldn't. And is that your understanding? Because I think I just heard that you could invade the corpus with this. I guess I want to hear your take, Mr. Chairman.
Well, okay, since you ask, so yes, you can read the bill. The inviolate nature of the fund is not a change. The inviolate nature remains. So the question I think that you have to ask yourself, and the way I look at this bill right now is, this bill doesn't require change in current practice. With one exception, the one exception is now you would have the permanent fund, which you might call it the corpus account, but the permanent fund would be defined and delineated under the Constitution, and everything over and above that is defined and delineated differently. Other than that, it doesn't affect current practice at all. The legislature currently defines a spending policy. The legislature currently prescribes the investment. It does so by simply saying we changed it a couple of years ago on recommendations, Treasurer's Office, so there's basically a risk-based design now. So as long as the State Loan and Investment Board, the SLIB board, will continue to set the investment policy, and then the treasurer will execute the investment strategy with the investment policy. It allows us to start to move in the directions we talk to, but does not require us to move in those directions. And if you can't get the consensus to move forward, then it will simply stay where it is. As far as the statutory changes, I think we've gone about as far as we could go. We went about as far as we could go last year with 121. I think you've gone as far as you can go without changing the Constitution, and particularly in the PMTF and the School Permanent Foundation, which you haven't talked about yet. But I think that one we certainly have gone absolutely as far as we can go without changing the Constitution and the act of admission. So I guess we can talk about the chicken and the egg and which comes first or second, but ultimately it's going to take further act of the legislature to do anything different. And like I say, I don't think this bill changes anything that we do now, requires any change, other than we would basically develop and understand and have a corpus account as opposed to, and we know everything separate, which we already informally do that now through our cost basis and through some historical accounting, but it's not particularly defined. But that's how I see it. The corpus remains inviolate under the principle, and that hasn't changed, and it doesn't look like, I haven't talked to anybody who's interested in changing that. So that's my answer to your question, Representative Harshman. All right, are we ready for the question? All right, all those in favor of well, I guess we take the roll. Go ahead and call the roll on the bill.
Yes, sir. On 22 LSO 0307 as amended, Representative Schwartz.
Aye.
Representative Obermueller. Representative Obermueller.
No.
Thank you. Representative Larson.
Aye.
Representative Harshman.
Aye.
Representative Hallinan.
Aye.
I'm sorry?
Aye.
Thank you. Senator Nethercott?
I guess she's excused.
Thank you. Senator Kinski?
No.
Senator Hicks?
Muted.
No.
Thank you. Senator Guru,
Aye.
Senator Driscoll,
No.
Vice Chairman Nicholas,
Aye.
Chairman Perkins.
Aye.
7 aye, 4 no, 1 excused.
So, Mr. Chair, I think you've got 3 Senate no votes.
Yes, I do.
So I'm thinking we ought to proceed, but I'm wondering if you can't have take a short break, because we've been going for a while, and maybe have a chat with your fellow members to see what we can
let's
do.
let's just move it along. We've got the vote. Now let's just move it along. Let's make it let's start it as a House bill.
Well, I'm not sure we can do that. Generally, the policy is that it has to be a majority of both houses.
No, this is a select committee.
Okay, so we can do it. That's fine. Then we'll make it a House bill.
Okay. All right, let's go to the next bill.
Mr. Chairman, I'll proceed if you're ready.
Yes, please do.
Okay. Yep. Mr. Chairman, 22 LSO 379 working draft 0.7. I have the good fortune of following Mr. Shaw, because a lot of what takes place in this proposed amendment is the same as the permanent trust fund. Just walk through the bill quickly. The first thing I would note is that there's more changes, more sections that are being changed here just because of the need to make more conforming amendments. And most of them are to strike references to either income or interest and replace those with the term earnings. So that's the change on page 2 on Article 7, Section 2. Article 7, Section 6, that's the same in line 14. And then the meat of the bill begins on page 3, and it would continue with the statement that the legislature provides by law for the investment of the fund subject to the following. Then page 3, line 21st is that earnings, which may include both realized and unrealized gains, are deposited in a separate earnings fund. So that concept is the same as a permanent trust fund, as well as that deposit must take place on at least an annual basis. Then earnings in that separate earnings fund may be invested or distributed as required by law. And then page 4, line 5, the legislature shall prescribe by law the manner, means, and timing for supplying losses identical to the PMTF. The changes to Article 7, Section 7 and Section 8 are just conforming amendments to move to the nomenclature of earnings. That's the same on page 5. For Article 7, Section 9. And then finally, Article 18, Section 6, this is amended on the top of page 6. Current law requires that if any portion of the interest or income is not used in any given year, then that is retained in the common school account. This would provide that if any portion of the earnings are not expended, that portion of the earnings would either be retained in the earnings fund or become part of the common school account as provided by law. The only other thing, Mr. Chairman, that I would note is that this draft does not contemplate a spending policy amount. And the primary reason for that is the other provisions of the Constitution that contemplate, and case law interpreting those provisions that contemplate a requirement for the legislature to basically provide an equitable allocation to the schools. A spending limit in this regard may create the issue of having to decide which provision the legislature would have to follow if a subsequent court case, for example, were to say, X has to be spent. Then finally, Mr. Chairman, the staff comment on page 7, this has already been mentioned previously today, but this is the language from the Act of Admission, specifically sections 5 and section 7, that state that the interest of that perpetual school fund shall be expended for the, and only the interest shall be expended for the support of the common schools. So that's just a note to the committee that at some point for our constitution to conform to that, the active admission would need to be changed in some manner to update those references as well. With that, Mr. Chairman, I'll stand for questions.
All right, thank you, Brian. Brian, just have you looked into the process? What does it take to change the active admission, and how does that? What's the order in which these things have to occur?
You know, Mr. Chairman, I'm not sure there is any set process for doing this. From what I gathered, you know, in our discussions with Idaho, it took place about 2 years before they proposed and adopted their constitutional amendment. But in terms of the language, based on Idaho's language, it looks like that language for the active admission was drafted to track what was being contemplated for their constitutional amendment. You know, in terms of a process, I think it's you know, straightforward as having a member of Congress introduce a bill to amend the active admission. You know, what that language looks like, you know, I think the committee could certainly, or any legislator could, you know, proffer that. In terms of the timing, you know, of this, that certainly is a harder question. Our constitutional, you know, amendment, should it be adopted by the legislature and then by a vote of the people? You know, as it stands, if the active admission isn't amended, you know, there would be some difference there in terms of that reference to interest. The one thing I would note is that Utah amended their constitution, and in our conversations with them, were advised that they did not need to change their active admission. So theirs, as far as I know, was not and has not been changed, even though their constitution has. And certainly those decisions are policy decisions for the committee, for the legislature. But Mr. Chairman, hopefully that answers as best I can that question.
So if you're going to go about the active admission, does it take a bill, or does that take an act of the legislature? Or if the legislature were to pass this bill and move it to the vote of the people, is that then an implied request for the change the active admission so that they're not in conflict?
You know, Mr. Chairman, I'm not sure about that. I'm not sure if, you know, I think at the end of the day, what needs to happen is a member of Congress, you know, whether it's our congressional delegation or someone else, would have to, you know, introduce a bill and you know, propose an amendment to the active admission in Congress.
So I will confess, I don't know active admissions. I wasn't around when we applied for statehood, so I don't understand how active admissions go. So if it was an active admission, it had to be passed by the territorial legislature in order to go. And does that take an act of us to? I mean, somebody has to authorize somebody to bring an act on behalf of the state, a request on the state of Wyoming to change this active admission. Who authorizes, or who? I mean, does a congressman or a senator have the ability to start that on their own, or do we know?
Yeah, Mr. Chairman, I think it would be the same as our state legislature. You know, any legislator, you know, or committee can, you know, introduce a bill. I think it would be, you know, the same for Congress. You know, any representative or senator could, you know, of their own volition or on request of, say, a single state legislator, or the request of a committee, or the request of the whole state legislature, you know, could propose that amendment in Congress.
All right. Thank you. All right. So questions, Vice Chairman.
So, Brian, you said that one state felt that they didn't have to do a change to the active admission. So have you done the analysis, or is their active admission different than ours, or they're doing something different than we did? And then have you looked at what other states have done? For example, should we make a motion? Does it make sense that the joint resolution ask our elected officials to pursue a change of the active admission if necessary. And should we word this thing in such a way that we can do it either way? In other words, make a presumption that we don't have to change the active admission but we're going to do it if we can, but we can move forward without it. So we're not locked into it in terms of moving forward.
Yeah, Mr. Chairman.
Go ahead.
Mr. Vice Chairman, a joint resolution requesting, a member of, say, Wyoming's congressional delegation, that's certainly, a decision for the body, if that's how they want to proceed. In terms of Utah specifically, as far as I can tell, their active admission also uses, I believe, the term interest. And what I'm not privy to is their analysis for why they concluded that a change was not needed, even though they did amend their constitution to use the term earnings versus interest.
All right. Other questions about the bill? Other questions about the bill? All right, so obviously I think one of the primary differences that I see in this bill, Brian, is that in this case, the original Constitution uses interest and income, doesn't use earnings. We have, over the last number of years, we have used earnings to include realized capital gains and other items like that to also be distributed as important rules. And so this modifies that to reflect more of the current practice. And then, of course, then it also extends then the ability, much like we did before, the same concept of realized and unrealized gains and the obligation to restore profit. Is that correct, Brian?
Mr. Chairman, I must confess, you cut out there for a little bit. In terms, so I'll try to take them as I heard them. This change to the Constitution would align with the statutory references to earnings. And then beyond that, Mr. Chairman, this language would track pretty much the same as a permanent trust fund in terms of the changes here. So a separate earnings fund, and then the legislature prescribing a means and method for supplying losses to the perpetual school fund, the common school account.
Okay. All right. Thank you. Any other questions? We'll go ahead and open it up for comment then. Is there any comment on this bill? All right.
Yeah, Mr. Chairman.
Yes, go ahead, Treasurer Meijer.
Yeah, I was just looking on page 4, and the same thing is in the other bill. And that has to be page 4, line 6. It says manner, means, and timing for supplying losses to the perpetual funds. And I'm wondering if we're actually offsetting losses rather than supplying losses, because the losses already occurred in the manner of the market.
And I had that same question out. Then I asked Brian and Ian to respond to that.
You're breaking up, Mr. Chairman. You're speaking like Johnny Mathis.
Oh, I'll take that as a compliment, actually. So I had the same question, and I talked a little bit about I think it was Ian. We talked a little bit about that, and Ian, if I remember right, this is the language that Idaho used on basically in putting kind of the Meijer rule, the interpretive rule, which we put in statute last year. Basically, it simply puts it. The effect of this is to put a requirement on there for the legislature to deal with those losses sooner or later. Ian, is that about right?
Mr. Chairman, that's right. And I'm going to actually let Brian speak to that as well, because he actually did then some separate research on that issue. So I'll let him address that.
Yeah.
Okay, Brian?
Yeah, Mr. Chairman, in addition to, first off, that is a term indeed that is used in Idaho's constitution. Other states throughout their histories have also used the term supplying. The earliest reference I could find actually went back to 1895, and a court in interpreting supplying was just basically paying or making whole, making losses, making good on losses is basically what those courts have said to that. So, that's really the primary reason for using that term. It's one that's been used. It's one that's known by courts.
Okay. So, Mr. Treasurer, did that because it's odd language, the term's applying to me, but that was the answer I got. Does that help you? I don't see Mr. Treasurer on here anymore. Anyway, okay. Any other comments on the bill? Any other testimony or anyone like to speak on the bill? Anybody in the waiting room?
Mr. Chairman, we have no one either online or in person.
All right. Thank you. Gentlemen, the committee, what's your pleasure on the bill then?
Move the bill.
Got a motion and a second. Motion by Vice Chairman Nichols and second by Senator DeRue. Is there any discussion on the bill? Go ahead, Representative Hellman.
Thank you, Mr. Chairman. I have on page 5, line 14, an amendment to offer, and I would delete 21 years and would put in 18 years. We do currently charge tuition in the college, Wyoming University, and I think it would be appropriate that we would have our constitution that would be consistent with our current practice. Our practice is that we do charge tuition at the university, and I think that it is appropriate that this constitutional amendment would cover that issue by changing the 21 years to 18 years. With that, I would move that amendment, Mr. Chairman.
Okay. Representative Larson. Oh, we got a second by Senator Hicks. Representative Larson, those are all seconds? Okay. Discussion on the.
I just have some discussion on the bill, if I may, Mr. Chairman.
Well, we're on the amendment. Well, we've got this amendment that's been seconded now. We're on the amendment. Is there a discussion about the amendment?
That's what I was raising my hand for, Mr. Chairman.
Okay, go ahead.
So my challenge with that is particularly as you look at the requirements under IDEA and other special education, we're required to provide that free education through age 21. And so I think if you reduce this back, I think it's problematic and would think we ought to just leave it alone.
Yeah, Mr. Chair, I would concur with that. The age 21 isn't addressing funding community colleges or colleges free of charge. It's providing a high school education through the age of 21. And so that includes the folks that drop out, the special needs folks that who continue to have and require services because they haven't graduated from high school. So I understand the thought, but I think that this really addresses a different issue than what the good representative just talked about. So I would stand against the amendment.
All right, thank you. Other discussion on the amendment? We're on the amendment. All right, all those in favor of the amendment, raise your hand. All those opposed to the amendment, raise your hand. All right, that amendment fails. All right, we're back on the bill. Are there any other amendments to the bill? Any other discussion on the bill? All right, let's go ahead and we'll call the roll on the bill then.
Thank you, Mr. Chairman. On 22 LSO 0379, Representative Schwartz has left a proxy vote aye. Representative Obermuller.
No.
Representative Larson.
Aye.
Representative Harshman.
Aye.
Representative Hallinan.
Aye.
Senator Nethercott.
Excused.
Thank you. Senator Kinski.
No.
Senator Hicks.
You're muted.
Senator Hicks,
No,
Senator Guru,
Aye.
Senator Driscoll,
No.
Vice Chairman Nicholas,
Aye.
Chairman Perkins.
Aye.
7 aye, 4 no, 1 excused.
So, Mr. Co-Chair, I think it makes sense that we run these two together, just because I think it's easier for the bodies as opposed to having crisscrossing. So we would be happy to have this to be a House bill as well.
Okay. All right. Thank you. We'll do that then. All right. Everyone, thank you for your time today. Is there anything else we need to visit about before we dismiss?
Mr. President, I really do enjoy it when your co-chair is happy.
Notice that. Anyway, thank you. All right. Well, if there's anything else.
Yeah, I think maybe we should have another meeting tomorrow, don't you think?
Let's don't say we did. So anyway, let's. All right. If there's nothing else.
Mr. Chairman, if we do have a meeting, could we take our redistricting tomorrow?
No, please, again, let's don't say we did. How about that?
What's the dress code?
All right. Well, thanks so much, Ken, Patrick, Josh. Thank you, everybody. Lisa, thank you for Mr. Treasurer. Thank you all for your time today, and we'll